Hi everybody. In this video, we'll begin a discussion of inventory cost flow methods. Regardless of whether the perpetual or periodic inventory system is used, it is necessary to assign dollar amounts to the physical quantities of goods that were sold and also to the goods that remain in ending inventory. I want you to be very familiar with a formula. It's a very important formula. And that is that beginning inventory plus net purchases equals the cost of merchandise available for sale. And that inventory that was available for sale during an accounting period was either sold or it was not sold. The cost of the inventory that was sold is transferred to cost of goods sold, leaving the cost of the inventory that was not sold in ending inventory. And this formula also works backwards. Ending inventory plus cost of goods sold should equal the cost of merchandise available for sale immediately before the sale, and this formula is frequently used to especially in a periodic inventory system, to calculate the cost of ending inventory. Beginning inventory plus purchases equals goods available for sale minus cost of goods sold will equal ending inventory. You can also use this formula to calculate cost of goods sold. Beginning inventory plus purchases equals goods available for sale minus ending inventory will equal cost of goods sold. So this is a very powerful formula. We're going to use it a lot, and you do need to study that formula and understand how it works. Unless each item of inventory is specifically traced through the system, assigning dollars is accomplished by making assumptions regarding how units of goods and their associated costs flow through the inventory system. There are 4 common cost flow assumptions: specific identification, average cost, also called weighted average, first in, first out, referred to as FIFO, last in, first out, referred to as LIFO. Let's talk briefly about how each of those 4 cost flow assumptions work. Then we'll get into some actual practice. Sometimes it is possible for each unit of inventory sold during a period and each unit on hand at the end of an accounting period to be matched with its actual cost. Actual costs can be determined by reference to the invoice representing the purchase of the item. The specific identification method is used by companies selling unique, expensive products with low sales volume, which makes it relatively easy and economically feasible to associate each item with its actual cost. For example, automobiles have unique serial numbers that can be used to match a specific automobile with the invoice identifying the actual purchase price. If it's not feasible to specifically trace each item of inventory throughout the accounting period, then companies can assume which units of inventory have been sold and which remain in ending inventory. It is important to note that these cost flow assumptions are assumptions about the cost of the inventory, not actual product flow assumptions. Average cost assumes inventory cost is a mix of all goods available for sale. Average cost is weighted by the number of units. We will practice. First in, first out, or FIFO, is the most common cost flow assumption used by companies in the United States, and that assumption assumes units first acquired are first sold. Therefore, ending inventory consists of the most recently acquired units. And last in, first out, or LIFO, assumes units last acquired are sold first, and ending inventory consists of the first units acquired. We'll use the Browning Company for an exercise in each of the cost flow assumptions. But let's talk a little bit about Browning and make sure we understand what's going on here. Browning has a beginning inventory at the beginning of 20X1 of 4,000 units on hand, and the cost of those units was $5.50 each. On January 10th, they sold 2,000 units. On January 17th, they had purchased 1,000 more units at a cost of $6 per unit. On March 22nd, they purchased 3,000 more units at a cost of $7 per unit. On April 15th, they sold 1,500 units. On October 15th, they purchased 3,000 units at a cost of $7.50. And on November 20th, they sold 3,000 units. It's very important to remember that formula we worked with at the very beginning of this video. Beginning inventory plus purchases equals goods available for sale. Here is the beginning inventory for Browning. 4,000 units at $5.50 each equals $22,000. They made 3 purchases during the year. They purchased on January 17th, $6,000 worth of inventory. That's 1,000 at $6 each. On March 22nd, they purchased $21,000 of inventory, 3,000 units at $7 each. And on October 15th, they purchased another 3,000 units and paid $7.50 each, for a total of $22,500. So their purchases throughout the year were $49,500. Beginning inventory of $22,000 plus purchases of $49,500 equals goods available for sale. When we come back in the next video, we'll start working with the FIFO cost flow assumption and see if we can figure out how to apply the cost of the goods that were sold in each of the 3 sales they made during the year, and how under FIFO we will apply the cost of the goods were not sold in each of those sales. Talk to you later.